Now, let's go back to our example of risks related to adverse developments in external trade. And let's look at our countries that we looked at before, Philippines and Belarus. So as you can see, in both cases, IMF country teams flag some additional risks that might arise in the event of a poor global trade environment. These additional risks reflect the financial consequences of a worsening of external trade, weaker investor sentiment, financial spillovers. So you can see that for Philippines, they were worried about weaker investor sentiments, and in the case of Belarus, they were also talking about financial spillover effects. Now, these two countries are not the only ones where adverse external trade events can spill over into a deterioration for the country from a financial point of view. In the broadest term, such a financial deterioration may mean tighter external financial conditions, once again, the risk premium that we've talked about for the country, that is transmitted to higher domestic interest rates, and that includes the public sector. So what we need to do is take a step back and think about the channels of transmission from the external to both the fiscal and the financial in a hypothetical country, one that faces the same kinds of risks as Philippines and or Belarus, but may not be in exactly the same circumstances. As is always the case, each country has its own individual circumstances and requires its own individual analysis. So we already learned that if we have a deterioration in a country's external trade situation, that is, if its export prices fall, there's going to be deterioration in the macroeconomic situation of a country. And let's specifically focus on the impact that output will decline, both from the external and domestic demand impacts. And this is going to have impacts on the fiscal. Without any kind of adjustment, once again, as before, we're going to see a deterioration in the fiscal balance, and that's going to mean more financing requirements, higher fiscal deficits, more debt. At the same time, we'd also expect an increase in the current account deficit, or I should say a deterioration of the current account. And once again, as we learned previously, that's both in price and volume terms. This can mean higher external debt, and also if a country tries to defend its exchange rate, this could mean a fall in international reserves. So now what happens next depends upon where the country started. If the country started from an initially strong position, solid macroeconomic performance, low inflation, a sustainable path for public debt, and a strong external position, it may be able to avoid adverse financial repercussions. However, a country that starts off in a weak position, low growth, high inflation, unsustainable positions in both the fiscal and external front, investors are now likely to take an even less favorable view of this country. And this less favorable view will be reflected how? Will be reflected in a higher risk premium, and I'm just going to draw in risk premium here, and we're going to draw this arrow to show that all of the deterioration here combined with an initially weak position will bring about an increase in the risk premium. As we previously discussed, these higher risk premia and external financial tightening will then be transmitted to the economy, both in the form, once again, of higher interest rates that squeeze out domestic expenditures and even more depreciation of the real exchange rate, which may mean a compression of critical imports, which are now more expensive than before. Moreover, it doesn't have to be the case that the country needs to be so extraordinarily weak in its initial situation for these unfavorable feedbacks to occur. A country may, in fact, be starting off in a more marginal position. Its fiscal and external may be sustainable under the initial, more favorable global trade environment, but then after the deterioration of external trade, the country will not enjoy the sufficient buffers that it previously had in both fiscal and external, in terms of fiscal debt and external debt and reserves. And in markets then may revise their view of the country, and once again, they require more compensation in terms of a higher risk premium, higher interest rates. So the sad paradox here then is that a country whose external position looked manageable before the shock may now face substantially greater challenges on the external financial front.